Hey traders, welcome to the top tier outlook for Sunday. I've got to find some better music. That sounds so serious, but it's the only countdown that I have here. We'll find something better. But happy Sunday, everybody. Hope you've had something away from the charts and away from the markets over the weekend. Hopefully there's better weather out wherever you may be than is here in South Florida. Pretty soggy down here, but perfect weather to set up for the coming week. I've been working on the top tier outlook today, taking a look at the issue that's going to go out tomorrow. We're going to discuss FOMC meeting minutes and what kind of glimpse they might give us into future monetary policy. We're going to look at the CPI aftermath, and truly it tells anything but a clear story. We have some sections of the market, whether that be energy, communications, financials, that are actually holding their own, while tech does seem to be struggling to find support, not in a downtrend, but definitely finding a wider range. And in that finding a wider range, it does look for a floor that might be lower than what we're used to for the past, well, since April, right? And then some of the aspects of the 10-year note correlations that sometimes are overlooked or even misinterpreted. What are correlations to the 10-year and how steady or strong are they? Correlations are not steady. Correlations are not 100%. They could be 50, 60%, 20%. So we're going to get into a lot of these things that are being discussed at the moment as reasons to be nervous and bearish and all sorts of things. But as my video on Friday started off with, is it time to panic? It's never time to panic, right? It is never time to panic, although that's what I hear a lot of. It's time to be discerning. It's time to find the trends that are clear. And it's time to focus on the opportunities that we have in, say, those uptrends that are still intact, right? And then I talked also in that Friday video about where the time frames will play a huge role in picking weakness, because there are a number of 1 hour charts for a slightly longer term intraday time frame that could set up for overnight exposure and short term swings. So there's a lot I know that we just unpack there, but bottom line, there are opportunities. The big hot zone for the week is going to be Wednesday's FOMC meeting minutes, although we do have a little bit of FOMC speak, as you can see here. Kashkari on Tuesday. Wednesday's the big FOMC meeting minutes, and then we go into jobless claims on Thursday, Philly Fed on Thursday, and then things are pretty quiet on Friday. But that Baker Hughes could be interesting, because one of the corners of the broader markets right now that looks really good is crude oil. Crude oil is climbing, and that uptrend that we saw organized at the very end of July continues here into August. And another one of the uptrends in the sectors that may not be the NASDAQ or tech related is energy. So please don't let an over-indexing, an over-bias to tech. Oh my gosh, Apple, Amazon, Tesla, NVIDIA. Don't let that distract you from the fact that there are strength pockets, right? Just pockets. And that's why having a watch list building process that's built from a top-down, a top-tier approach, index sector shock is so important. I'm still a big fan of the Dow. That's where, if I'm looking at the index level, we have the least exposure to tech, although clearly there is quite a bit of tech here. But Dow is going to benefit from financials. Dow is going to benefit from healthcare. Dow is going to benefit from energy, right? S&P is going to be basically maybe limping along because of tech. But Russell is going to look pretty good relative to what's happening in tech, because we still have a good degree of strength in KRE, and this is the number one weighted sector in the Russell, and even the S&P. I kicked off some of the early commentary in the top tier with a look at the fact that we are starting to look. Finally, it's taken this long. It's taken this entire journey of the last 2 weeks to get on the daily time frame from an overbought to an oversold, from the high to the low on the slow stochastic. And now DPMRs, minor low signals, are starting to come into focus. And it makes a lot of sense if we're looking for a quick rally to take advantage of, this would be it, right? I'm not saying it's in an uptrend, but this would be where the bounce zone would be. All right. And then, by the way, when we get back up to an overbought stochastic and up near the daily price movement ranges, we might end up looking at another move to the downside. So again, remember, August is range bound. It goes from floor to ceiling, ceiling to floor. We just got to be patient for price to get to one of those two levels with the confirmation that we love. All right. So as always, gang, this show is about your questions. We're gonna be going 6 to 6:20 on Sundays. And so if you've been enjoying the show on Sundays, thanks as always for smashing that like button. Leave any comments, leave any questions that you might have, and let's go ahead and dive into our questions. All right, first up, Nick asks, what is my take currently on the euro versus the US dollar? Sure, let's take a look at the 6E. Now, for most traders, this is going to be the most accessible way to take advantage of the euro. When the euro's moving lower, that means the dollar's moving higher. So what I teach a lot of traders to do, rather than looking at, say, the DXY, or rather than looking at the UUP or the DX futures, look at the 6E. It's more accessible because it's on the Chicago Merc. It's very liquid. And there's a good ETF, FXE. And then, of course, Euro-US Forex is the biggest market of any kind on the planet. It's the largest Forex pair as well. So what I'm looking at here in terms of the euro is not quite a downtrend, but much like the S&P that I just mentioned, we have, as of about the 9th to the 10th, finally reached the low on the slow stochastic. Now, let's cover something here really quickly. I'm going to walk you through some basic analysis for those of you that may not be familiar of what's on my chart. Everything starts at the bottom. I mean, think of it bottom up. We start with the foundation. We've got to have a good foundation. Our foundation for all my trades is the thing that I call the multi-trend. The multi-trend right now is yellow. Yellow means we have a neutral, non-trending environment. That means that I'm looking for oversold support. I'm looking for this low stochastic to travel lower to this area. And at that point, it's oversold. And then if that oversold level can correspond with the daily price movement ranges, right? If it can, then I've got a setup. So I would like to get long euro. I don't want to get short here. I would like to get long euro. So my take on this, whether that be 6E, FXE, or the euro US, getting long once we have the oversold stochastic. And you might say, but Rag, how would you get short? Flip it around. If this line travels back up, right, the slow stochastic line travels back up to this area, to this high, to overbought, right? If it travels up to this area, and then correspondingly, we have an opportunity in the gold zone, right? That's the resistance, right? That's the resistance of the daily price movement range. We'll take the other side of the trade. So depending on which end of the range price is at, depending on which end of the range the slow stochastic is at, we'll have, depending on that, a short or a long setup. Right now, as you can see, Nick, we're favoring that buy. Yeah, we're favoring that potential long setup based on where the indicator and where price and our volatility support happens to be. All right. Good morning, or happy Sunday. Good evening. Absolutely, Captain Jane. How are you? All right. Apple. Hey there, Mr. Walker. So if I'm looking at Apple on the daily, Apple is a big reason why, because of high concentration weighting, the NASDAQ, the triple Q, the XLK is moving lower, right? This has such a huge amount of percentage weighting that just a move like this can really send those sectors and those broader averages lower, because the tail can wag the dog, especially when the tail is Apple and it's wagging like crazy. The tail, the smaller thing, can wag the whole dog, and that's what we have right here. However, let's stick with the patterns. Neutral, right? Here we are as of this cross in here. That crossing right there, we're oversold. We're at support in the neutral environment. That's the beginning of, hey, there could be a bounce, but that's not all we want to do, right? Once we get that level, I want to either get into the daily price movement range, which we did. I mean, take a look. Daily price movement range, daily price movement range, daily price. You might say, Rog, how come those weren't setups? We weren't oversold in the stochastic. We really want to wait for an indicator that finds those overbought and oversold levels going back and forth. We want to see everything in this sequence really light up in such a way that we can be finding a higher probability level of support. And you might say, Rog, what happened to this uptrend? Earnings happened to this uptrend. And this is why I tell my members, please don't trade those 24, even 48 hours into earnings. You know, play the rally into earnings. This worked great the weeks, if not month, before earnings. But as we get into the final days before this release, I'd rather be flat, and I'll wait to see what happens after, right? So this is just a great example of why I don't want to presume that I know what's going to happen with earnings. It's a very binary, sort of scratch off lottery ticket kind of approach that I don't want to engage in. So I want to be out before earnings. Let's see what happens after. And now, finally, we're getting the culmination of, as we cross down in that area, probably the earliest I could have bought the DPMR would have been right there on the 9th. The 10th held. 11th made a slightly lower low. But really what I like to see is not just, and I think a lot of my members know this, we don't want to find not only this and this, especially after such a dramatic move and so much weakness, lower lows, lower lows, lower lows, lower lows. What do we want? We want to find a minor low. And what that means is we're looking at a price-based pattern that's going to set up what looks to be a pause. That's what I'll be waiting on. And if tomorrow we take out, say, 178.65, we're on a path to establish that minor low, as long as we don't break 176.50. So those are things that I'm watching for a potential setup on Apple. It's not, I'm giving you all a lot of pieces of the sequence because I really want y'all to understand the transparency with which I trade with our members and frankly that I teach. When you know these pieces, you can put them together, all of a sudden you realize you're not chasing the market ever. It's coming to you, right? It's coming to you because it's saying, see, I've done this, and I've done this, and I've done this, and now will you trade me? And now you say, yeah, maybe. It's the same thing if, the analogy that I love, being a batter at the plate, waiting for our pitch, right? But the cool thing is, as Grandpa Buffett said, and becoming Warren Buffett, we play in a no strikes called game. The market, the pitcher, can throw as much as they want at us. We don't have to swing because we can't be called out by waiting for our pitch. So this is how we wait for the pitch. We have specific criteria. So I hope that helps. All right. Let's see. Next up is John asks, what 3 limited TradingView indicators should I use on TradingView free account as part of the Sector Secrets trial? Okay, so if you're on, so this is what I would tell you to do, John. If you're on the trial, don't use the free version, right? Because you're limiting yourself to what you can do. What I would recommend is during this 30-day trial, this immersion with me in the Sector Secrets Mastery, go get a free trial because you can get a free trial of Premium or Pro and go get that trial. Use the trial while you're in the Mastery because that way you can use all the indicators that we make available to you during this time. So that's an easy way to go. I would not limit myself to the free account. Now, if that's something you want to do, cool. So remember, go get a trial of TradingView for the trial. It's very easy to do at tradingview.com. But if you want to stay with the free, I would put the grab, the wave, and the multi-trend on there. The grab, wave, multi-trend. That would be the basic foundation. But why limit yourself to the free TradingView when you can just go get the free trial of the more full-featured version? So that's what I would recommend. So it doesn't cost you anything. If you don't want to keep it, right, it's up to you. Let's see. And the grab wave is the same indicator. That's true. So grab wave, the bot's reminding me, use Darvis. Grab wave is one indicator. Darvis is one indicator. And multi-trend would be another. So if you're just using the free, cool, but don't. Why limit yourself? All right. Next up, Caterpillar. Hey there, Glenn. Let's take a look at CAT. All right. So on CAT, I like the uptrend. This is, again, great question, Glenn, because for as much, oh my gosh, the rug's going to get pulled out from underneath us kind of talk there is some strength and there is some decent support in things like IYT and XLI and Dow, right? Which actually is still in an uptrend. So that leads us to things like CAT. And ultimately, if we look at something like this, if we look at something like CAT, in an uptrend, there's two ways to look at that. You can look for a mean reversion. For me, that would be the 34 EMA wave, right? Or you can wait for a volatility support level, right? And that would be the gray zone of the DPMR. So I would, or even use the Darvis 2.0 or the Darvis 3.0. Both of these would be DPMR or Darvis would be excellent places to look for support. So the way I would look at this, Glenn, is definitely buy. In fact, the multi-trend doesn't even allow me, again, on the daily time frame, it doesn't even allow me to short, right? It's very directionally clear, buy or nothing, right? And that's how we'll play this. So I'll wait for price to get into the zone, quite literally, either DPMR or nail that Darvis base support. All right, next up, Howard asks, can I take a look at Google? Sure. Google is part of the XLC. XLC is a corner of the market that we are long in the mastery. Why? Because it looks better than NASDAQ. It looks better than the consumer discretionary. It looks better than tech, and it's got two very strong tech stocks weighted within that singular sector ETF. Meta, pretty darn strong overall, and Google pretty darn strong overall. I like Google. I like XLC, and I definitely like the idea of buying in the same way that I was mentioning to Glenn, Howard, the way I talked to Glenn about the zones for CAT, same thing, right? Once we have the structure, the symbol may change, but the setup doesn't. Darvis, DPMR, green trend, we're looking for that buy the dip. Am I waiting for a mean reversion? Could happen. But if not, I've got two automated tools there waiting, practically daring price to come down there so we can buy it. What about watching yen tonight? Paco, I will not be. No, I'm not gonna start trading tonight in terms of yen or otherwise, but just in general, if I'm looking at the J7 or J6, day trade it. If you've got a red structure, which we do, I would just day trade it or night trade it, whatever you want to call, but no, I won't be trading tonight. All right. My thoughts on adding to swing positions and the weakness on TLT. I need a setup on ZB. And until I get that, nothing doing. Yeah, I'm going to be sitting on the sidelines until I get that set up. So if ZB doesn't give me a setup, and it can't, right? I can't get short an uptrend, and I can't get long a downtrend. When that multi is red, no go. Now, I'll probably get an opportunity quicker and more nimbly with a shorter time horizon on the hourly. So if what I would recommend, Glenn, if you're looking for TLT, start on the 1 hour, look for the 1 hour to go neutral, and then we'll look for an opportunity. But quite frankly, right now, it is a short. It is a short. So yields are telling a very interesting story. Yields are actually playing a little bit of a game of chicken with the Fed, saying, we don't think you're hiking enough. You might be going to a pause and cuts too quick. That's what bond traders are saying, right? Do bonds move the entire market? They do. They sure do reflect a lot of risk appetite and concern. And because of that, especially that you'll notice in the already shaky indices and sectors, mostly tech, that shorter 10-year has been a bit of an influence. But ultimately, I'm going to wait on the sideline till I get better clarity. Right now, bonds are a short. And that's a wrap, gang. I'll see you all in for Charts and Coffee tomorrow morning, 9 a.m. Enjoy the rest of your weekend. Thanks as always for being here with me. All right, gang, be good to each other. Until tomorrow.